Hello, everyone. Today we are going to talk about technical analysis versus fundamental analysis and why I prefer technical analysis. Well, if you've been in the market for a while, I'm sure you've heard of these too. So there are supporters of both camps. They're they are technical analysis guys, fundamental analysis guys and gals, and sometimes you will encounter them in forums and chat groups, and they will sometimes sometimes they're going to um, um, contend against one another. Ours is better than the other way, the way of the other way of doing things, and that the other side would also say, no, ours is better than yours, and it's us versus them situation. It's a versus kind of thing. It's like if you are a techie, you might have encountered Emacs versus V, Windows versus Mac, Intel versus Apple right now, and like that. So both camps have strong supporters, and so you are here and you encounter these terms, these approaches, and you're not sure um what are these things and what should I use? How should I use them? Okay, so what this video is one of those which hopefully can guide you into whatever method you prefer. Of course, while I prefer technical analysis, I'm not saying that um, is the only way. No, it is what I prefer, and of course, I will tell you why I prefer that. So that if you have the same situation, if you are in the same circumstance, if we have the same preference, then maybe you'd also prefer it. If not, then you'd say, yeah, you prefer it because of what you say, but that doesn't apply to me. Then good, well and good. Then you can use fundamental analysis. One thing for sure is that not one of them is clearly superior, because if that is so, then if for example fundamental analysis is like the best thing since sliced bread, then why is there still technical analysis? Why are people still using it if it doesn't work? If FA is the best thing ever, why is there still technical analysis? Why do we even bother with it if it's no good, right? And the same is true with technical analysis. It's not a silver bullet. Each of us individuals have different way of looking at things, and sometimes one approach fits better with the way we think and the way we do things, and it just um it's just in harmony with who we are and how we look at things. So if that's the case, then that's the approach we use, because ultimately we all just want to succeed in the market. It's not I'm here for technical analysis to win and our financial analysis, fundamental analysis to win. I will fight for it. Um, Come what may. No, we are here to earn, to make money in the market, and or at least to survive, right? So that we won't get wiped out, even if that's just even if okay, just a bit of profit. Okay, I won't earn that much. Yeah. But that's ultimately what we are here for. We are not here for our pet to win or our camp to win. It's not like that. So I hope we will end the bashing, all those um, FAs bashing TAs, TAs bashing FAs. It's pointless. It's pointless because, again, those are tools to help us earn. And if you're earning from FA or TA, then who cares, right? I mean, you're earning. That's what's important. Okay, so with that, let's move on. Okay, so what are these things called technical analysis and fundamental analysis? What are these? What are they? What do they do? How do they help me? Okay, why would I use them? How do I use them? Okay, well, these two ideas, these two methods, fundamental analysis and technical analysis, are the two main ways of analyzing financial instruments, securities, commodities, like that. Because when we go into the market, we go with the intent of buying or selling a stock or an option, a futures contract, a CFD, or other derivatives, or Forex currencies, right? So we want to buy or sell. Now, the question is, we go into the market and we see that Tesla is at this price. Okay, should I buy or should I sell? Right? You don't know. Should I buy or should I sell? The answer to that, okay, that question is precisely why we have technical and fundamental analysis. These two methods are different approaches for determining whether we should buy a market or sell a market. Okay. So, like I said, Tesla is trading at price X. Should I buy or should I sell? If you use technical analysis, then you will have a toolbox with different tools for determining whether you should buy or sell that particular stock. As to what those tools are, well, we will discuss it in a different video because there are a lot of tools, and not only are there a lot of tools, there are a lot of ways of using those tools. Let's say, for example, a market average, a simple moving average. How do you use that? Besides, just just considering the SMA, there is SMA 9, SMA 10, SMA 5, SMA 40, SMA 50, SMA 200. Which of those should I use? And that's just SMA. We haven't even touched EMA and other MAs. And that's just for the MAs. There are other indicators, oscillators, momentum indicators, indicators based on price, based on volume, all those kinds of things. We have things like Bollinger Bands. We have Fibonacci retracement tools, trend-based fib tools. We have my favorite, Pitchfork, and even the Pitchfork, it has three different variants, and there are harmonic patterns, Western patterns, candlestick patterns, all those kinds of things. There's a lot. So, of course, we are going to discuss that hopefully in different videos. I'm going to make some of those, hopefully a lot, if you want to. If people would like to have more of these kind of things. But, okay, so That's an approach, okay? So you use technical analysis to determine whether you want to buy or sell. It's the same thing with fundamental analysis. So, should I buy or sell Tesla? I will use the fundamental approach. They also have their own toolbox, a set of kits, tools for them to determine whether it's good to buy or sell the stock. So basically, that's it. Technical and fundamental analysis offers tools, methods, approaches for a market practitioner, for a market participant to determine whether he or she should buy or sell a particular security or commodity, and like that. So now let us move on to fundamental analysis. Like I said a while back, both fundamental and technical analysis aim to answer whether to buy or sell a security. Let's say a stock. Okay, let's say Meta. Okay, should I buy Meta? And if I use fundamental analysis, this is normally how it goes. How does fundamental analysis help you in determining whether to buy or sell Meta? Okay. Well, fundamental analysis aims to determine the intrinsic value of a security or commodity. What I mean by that is that each, say, stock has an intrinsic value. And fundamental analysts believe that you should determine this intrinsic value. What they would say is that why buy something that you don't know the value of, right? I mean, how are you going to know if you're paying high or low? Let's say I'm going to buy let's say something not gold, okay? Let's say there's a jewelry and it's made of a metal that's unknown to you, and then you want to buy it. It's priced $100. Well, is that cheap or expensive, right? I mean, if it's gold, then maybe you'd know because the value of gold is like that, but it's something you don't know. How would you know if it's worth buying or not? You really have to know the value, the intrinsic value first, so that you can determine if the price is right. So that is what fundamental analysis aims to do. It wants to know whether Meta, whether it wants to know what the intrinsic value of Meta is, so that let's say it determines the intrinsic value of Meta to be $50 and it is selling for, let's say, 100. Well, then that's expensive because it's only worth 50 and it's selling 100. So no, I'm not going to buy it. In fact, if I have Meta stocks in my portfolio, then I might consider selling it because it's expensive. Maybe next day it's going to go back to its proper price, and then I'm going to miss the profit, right? So I'm going to sell it. Okay. If it's lower, then, well, I'm going to buy it. That's what fundamental analysts would say. That's how they buy and sell. They want to determine what it is worth. And from there, they will look at how much it is selling. And then they would know whether to take the offer to sell. I'll take that offer. I'm going to buy it. Or nah, it's too expensive. I'm not going to buy that. Okay, so that's how they go about it. They first determine the intrinsic value, and once they know the intrinsic value, then they will either buy or sell depending on how much it's going for. Now let's move on to how the technical people do what they do. How do they approach the buy and sell question? Now we move on to technical analysis. Yay, my favorite. Okay, so we discussed how fundamental analysis approaches the question of whether to buy or sell something. Now, how does technical analysis approach the same question? Well, technical analysis uses techniques, tools to determine how the prices are moving, okay, and then identifying any patterns in the price action, in the movement. Okay, why is that? How does that help buying or selling? Well, it's like this. Okay, let's talk about let's talk about Tesla again. Okay, because it seems like Tesla is very active right now. So Tesla. Okay, should I buy Tesla? Price right now, let's say it's okay. What's the price of Tesla right now? Hold on. Around 113. Okay. So, it's 113. So, what's that? Should I buy that or sell? Well, technical analysis provides tools to show the trader, the market participant, whether it is the price is moving up or down, or is it near its previous low, or is it near its high, or is it about to go down, things like those. In which case, say it is again at a 113. Okay, and you can see from studying the chart that it's climbing. Okay, it's climbing. Okay, it's in an uptrend. That's what chartists call it. Okay, it's moving up. Therefore, if I buy it right now, it's going to be its price would be higher in a few days or hours or months or minutes, depending on your time frame. So I'm going to profit, right? Okay, so I'm going to buy. See? But if the chart or the tools of the technical analysts tells him or her that the price is going down, oh, I'm not going to buy that because after a minute or an hour or a day, it's going to be lower, said my indicator. Based on the trend, it's going to be lower. So I'm not going to buy that because after some time, I'll be holding a stock with a lower price. And how am I going to sell that? I'm going to sell that at a loss, right? Let's say I bought it at 113, and based on the chart, it's going to go down. Okay, why am I buying that? Why would I buy that if after a certain time t is going to be 50, right? So no, I'm not going to buy that. In fact, I'm going to either sell my holdings or I might sell it short, which you'll learn later. I'd probably make some videos about shorting. It's a bit more advanced than regular buying, but that's an option for you if you think the price is going down. So I actually really don't care about the intrinsic value, right? As a technical trader, as a technical analysis practitioner, I really don't care about the intrinsic value. What I care about is that it's going down. regardless of whether it's valuable or not, if it is going down, I'll be holding something that I can sell at a higher price, right? So I'm not going to buy that, and I'm not interested in its intrinsic value, okay? Because there are a lot of instances when something that is valuable, okay, that has a high intrinsic value, but for some reason people don't want it. People are selling, and price, as you know, is dependent on supply and demand. So regardless of the intrinsic value, if there is more supply because people are selling than there are demands, then it's going to go down, regardless of intrinsic value. In the same way, there can be times when even something that has little intrinsic value, if people want that thing, people are flocking to buy that not so valuable thing, even if it's not so valuable, but since people are flocking to buy it, then demand overcomes supply. So so economics would tell us that prices would rise, right? Regardless of intrinsic value, if people want it. You can read about this, about the tulip mania. I forgot the year, but there's this tulip mania that happened historically. I think it's in the 1800s or 17. Not so sure, but you can search. You can find that. It was a time when the tulip bulbs became very expensive because people want to buy it and there's not so much to go around. Okay, so prices rose to unreasonable levels. In fact, I think the title of the book was Irrational Exuberance or something. I forgot. Um, it's already irrational, but prices rose, right? And for the technical analyst who sees that, well, he's going to buy because he knows that the trend is going up and that he can sell it at a higher price regardless of the intrinsic value, even if it has a very little value, but he knows that it's going to increase in price. And so he can sell it at a profit, right? Okay, so that is how technical analysts approach the buy or sell question. Now, before we go any further, I'd like to discuss the difference between charting and technical analysis. Are chartists and technical analysts the same? Is it the same? Is it the same thing? Because can I be one or the other, or am I both? Right, like that. So okay. They are not the same. Charting is a subset of technical analysis. So all chartists are technical analysts, but not all technical analysts are chartists. Although mostly they are the same. That is why oftentimes they are considered synonymous. That is why sometimes people use them interchangeably. Chartist, technical analyst. I'm a chartist. I'm a technical analyst. Like that. But if you want to be strict about it, they are not the same because technical analysis is the study of price action, market action mainly. Market action. It's not even just price action. Price is just a part of what technical analysts look at. They also consider volume, and in the case of futures, they look at open interest and things like those. Okay, so it's not only price, although mainly it's about the price, but it's not only about price. Okay, So, and price price can be represented in a chart, or even without a chart. You can have a list like a ticker. Okay, a ticker tape. It's not a chart, but if you study the prices, the price it's still technical analysis. If you study, in fact, in the past, when charting was not that accessible, it's not that widely available, or maybe expensive, a lot of traders actually just use actual prices. Okay, they had a board, they had tickers, and then um, the ticker reader would shout the price, and then there are board people that would write the price. Okay, price now is $13, and then it's 13.50, 14, 13.50 again, 14, and then they list it like that. I once read about one of the greatest traders, Mr. Livermore. Um, he used to analyze prices just with the prices themselves. So he has a notebook and he lists those prices and look at the prices, how it moves, and he has a method for listing prices. He will put it in a second column, I think, like that, if it rises, and a different column if it falls, and something like that. Something akin to a um, point and figure chart, which is a one of my favorite methods also in technical analysis. It is akin to that, except that instead of X's and O's, it uses actual prices. So it's not a chart. Okay, so you can be a technical analyst even if you're not a chartist, even without a chart. Although these days, usually we use charts, and so usually they are the same. Okay, but it's not always. But even in our modern times, um, even with the prevalence, even with the availability of charts, there are still instances when technical analysts don't use charts. For example, um, there's this group of people called quants, quantitative analysts. They use, or maybe another term would be computational analysis. They use computers to monitor the price and look for patterns. It is more statistical rather than visual. And I'm also planning to make a video about that, because that's one of the fields that I'm very interested in. Um, Algorithmic trading, quantitative analysis, statistical analysis, computational statistics, computational analysis, like that. If the quantity studied or examined by the analyst are prices and volumes, they are still technical analysts. Although quantitative analysis can also be used in fundamentals, because fundamentals also have quantities, and they have earnings, they have um, um, profits and ratios, and like that, and growth ratios, they have debt ratios, um, and similar things. So those are quantities, and if you use those, it's still quantitative analysis if you analyze those quantities. But if the quant uses mainly price action or volume or both, then it's still under technical analysis, because it's still a study of market action. And those people won't be chartists, because no charts were used. Okay, so let's move on to the next. One of the objections that people have over technical analysis is this: they say that technical analysis is guesswork. So, Is technical analysis guesswork? Uh-huh. I love this because I'm not sure how some people came up with this, but there's this accusation that technical analysis and technical analysts just guess. Okay, that is definitely not the case because, okay. Actually, in any form of analysis, there is a small amount of guesswork. There will always be uh, uh, an as um, uh, a guesswork. There will always be guesswork, some guesswork involved. Okay, but the truth is, um, it has even lesser guesswork than fundamental analysis. Okay, why is that? Because again, um, technical analysis mainly relies on price and volume or the market action. Okay, um, and from that from that data, they would um, determine using their tools whether there is a trend or not, and if there is a trend, where is it going? Is it going up or down? If it is going up, then there is a certain guesswork that okay, it is going up, so I guess it will continue to go up in the near future. Okay, so yes, there is a certain small amount of guesswork. Any form of analysis would require guesswork because unless someone would claim to know the future and what would happen, then there's no guesswork. Okay, but that is prophecy. That's not analysis, right? Okay. So, like I said before, while there is a teensy bit of guesswork in technical analysis, there is actually more guesswork in fundamental analysis. And you're going to say, what? That can't be. Fundamental analysis is, academic. It's based on science and numbers, right? It's based on um, financial statements and things like those. Okay, but did you ever look at those financial statements? When you do forecasting in fundamental analysis, you um um how do you call that? You forecast the future earnings, right? So you're actually guessing that that the company would earn the same way it did in the past months, in the past quarter, right? You're actually guessing because you don't know if let's say it earned 20%. It had an increase in revenue by 20% from month on month, quarter on quarter, year on year, like that. And how are you sure that it would still earn the same amount next period, right? You're guessing, okay? And okay, you are actually making assumption that the business climate, that uh, the circumstance surrounding the business would remain constant, because even if the revenue would, as you guessed, would be the same, would increase in the same amount or the same amount in the previous quarter or month, even if you are correct and you are accurate that the revenue, how can you be sure that the costs won't increase? Because if the costs would increase given the same revenue, then the earnings would decrease, right? How can you be sure that in the next year no competitor would come up that would offer a better product, right? You're guessing that everything would be the same, given the same thing, like that. But you won't know. So there is a lot of things you don't know that you just assume. Okay, How can you be so sure that okay, the revenue is increasing right now because their people like their product A, but how can you be sure that in the next year those same people still like the same product? People can be fickle. Maybe they want something else that's colored pink or something like blue. Oh, okay, I don't want that anymore because they don't offer blue. I want blue, and then the competitor has a blue one, and then that's what I'm gonna buy. Okay, or what if they just don't want the product anymore? Okay, suddenly, um, I'm not anymore interested in, let's say, um, phones. Okay, so what are you going to do? How is the company going to um, deal with that, right? So suddenly, your forecast, your revenue forecast is suddenly off the mark, right? And okay, there are other things. Foreign exchange. Okay, so this company A uses raw materials from company B from a different country, and then suddenly there's a change in in the exchange rate. So suddenly, the cost of producing something changes. That will throw your forecast way off the mark. Okay, and gas prices. It all affects businesses. How would you know? What happened in Ukraine right now, right? So you can't the fundamental analysts of a few years back couldn't have factored that in their analysis, right? So if you want to determine, okay, so fundamental analysis wants to determine the intrinsic value of something so that they can decide whether to buy or sell. The problem is, to determine the intrinsic value, you have to know a lot of things. And a lot of those things are beyond our current knowledge, and sometimes we just have to assume that some things would continue to happen, that some things will not happen, and things like those. So if if our assumptions are wrong or become wrong, then our forecast would become wrong, right? Because it depends on those assumptions for us to determine the intrinsic value, which we would use to answer whether to buy or sell something. Okay, so that's a lot of guesswork. That's a lot of assumptions. Okay, so for me, this question over here is actually more um, applicable to fundamental analysis rather than to technical analysis. Okay, so here is another complaint that some people have over technical analysis. They would say that, well, technical analysis relies so much on price action, price movement, volume, and price movement is random according to some academic paper. Random walk theory, all kinds of theory. It's a theory, so um, it has to be weighty and things like that. And technical analysis must be no good because it relies on something that's very random. Well, as to that, okay, I'm just including this because that random walk theory is very popular. They would say that prices are ultimately random, and that if it's random, then there's no point in determining patterns um, on it, and no point in technical analysis because it's random. So how can the price yesterday help you determine more or less where the price will go tomorrow if it's random, right? So Is it really random? That's the question that you have to ask yourself. And to answer that, you won't need me actually. Just go and open a chart of any security that is actively traded. Of course, don't look at illiquid securities, because those can, because it's illiquid, then sometimes there are no buyers, there are no sellers, so it is not a very efficient market, so prices could go all over the place. But it really doesn't matter, because technical analysts won't even trade those things. If it's illiquid, they won't trade that, so it won't really matter. So what we are interested in, even the fundamental analysts, they won't um, really touch um, stocks or securities, commodities that are, well, in the case of commodities, there's hardly anything that's illiquid. Most of them are liquid. There's just a few commodities that's traded. So, but in the case of stocks and some currencies, there can be some illiquidity, and in those instances, price could be very difficult to gauge, but you won't trade them anyway. So even the fundamental analysts, because it would be very difficult for them to enter at a particular price, because even if they determine that it has good intrinsic value, okay, so I'm going to buy it. But since there's no sellers, not much any sellers, so it could the price could suddenly go up, and then, oh, that's not what I planned to do. That's not the price I plan to enter. So even the fundamental analysts won't enter those illiquid markets. So if we only consider the liquid markets, then this objection, this complaint about price being random is very easy to bust. That myth is easy to bust, because all you have to do is look at the price chart. Take a look at, say, Tesla or AMD, Intel, Apple, Meta, Ford, the big names, the stocks that's often traded, the major currencies, not the exotic ones, the major currencies. And if you watch those charts, it is very clear that it trends. Either it trends upward, or it trends downward, or it trends sideways. Sideways is still a trend, although some would say it's sideways is trendless. They would say it doesn't have a trend. It's not uptrend or downtrend. It doesn't have a trend, but actually it does have a trend. It's just that its trend is sideways. You see, like for example, the cardinal direction. It's not only north or south, right? You have east and west. Those are still directions, right? So it's the same with stock trends or other market trends. Sideways is still a trend. And if you look at charts of um, actively traded securities, then you cannot but notice the trend in those securities. Okay, either they're going up or down. In fact, some trends are very regular. If it is truly random, then you would see dots all over the place, right? If the price is random, imagine. Can you imagine a random price? Like for example, Tesla is again, it closed at 113, and then tomorrow, it would be like $5. That's random, right? And then next day it's going to be 10 cents, and then next day it's going to be $1,000, and then $900, and then $600, and then back to $5. That is random. But is it like that? Go ask yourself. Is Tesla like that? Is there a chance that tomorrow it's going to be $5 or maybe $1,000? Huh? Is there a chance? Fat chance, right? Uh, it just doesn't happen. So this I'm really not sure how they came up with this, that prices are random. maybe a bit in the short term, in the very depending on the stock or the security. Sometimes some stocks are random in the short term, but if you go longer, how long, it would depend on the particular stock. Sometimes some stocks are random at 1 minute but shows a clear trend at 5. Others are still random at 5 but shows a clear trend at 30 minutes and something like that. There's no boundary wherein anything below 5 is random and above 5 is, not random. It's not like that. And some stocks even are even trending or non-random even at very small time intervals. Okay, so no, prices are not random, and even those stocks that are somewhat unpredictable, somewhat volatile, in very short time frames, even those stocks are not truly completely random, because like I said, if it were, then it could go from 1 cent to 1,000 to 500. That's random, but it's not like that. It can be volatile sometimes in the short time frames. It can be volatile, I admit to that, but it's not random, just volatile. And when you go higher, the higher the time frame, the more um, clearly, the more clearly you can see the trend. It's beginning to show patterns. Okay, actually, there still are patterns in lower time frames. It's just that it's volatile. It moves quite a lot, but it's not random. Moving a lot is not random. Random is 1 minute it's, or 1 second is 5. Next is 50. Suddenly, have you seen a stock like that? Well, I haven't. So, if ever you see one, just comment below and I'll check that stock. I haven't seen one yet, so I don't think there's something like that in the wild. So that's it. I mean, I really don't know how they came up with this, but I just have to address this because it is commonly thrown. It's commonly thrown at technical analysts. You use price, and price is random. No, not so. The next complaint some people have over technical analysis is that um, technical analysis relies on historical data, past data, and then they would say, "Can the past predict the future?" And they seem so proud about that. Well, that sometimes makes me laugh because, well, look, what they're saying is that they're so proud of saying that, hey, you guys rely on past data, and past data cannot predict the future. How can the past predict the future, right? Well, let me tell you something. Any form of prediction use past data. Even weather forecasting. Well, it always use past data. Where was the low pressure area a while back? Where is it going? Right, we always rely on past data. Why? Why? Because it's all we have. We don't have future data, right? Can you point me to a source of future data? Because I want some. All right? Nobody has access to future data. All we have is historical data in any form of forecasting, weather forecasting, satellite movement, forecasting trajectory of heavenly bodies, position of comets. Where will the comet go? It depends on where it was a few hours ago, and that's how they determine velocity and direction, right? Where was it an hour ago? Where is it right now? Looks like it's heading our way. Something like that, right? They always rely on past data. Even fundamental analysis. Okay, fundamental analysis, right? They always throw this to technical analysts. Like, technical analysts use historical price data to predict future price data, and that cannot be. How can the past predict the future, right? But take a look at fundamental analysis. What do they do? Do they have future data? No. They had the annual report, which already happened, right? That's past data. You use the annual financial report, the quarterly report that already happened, right? It already happened, right? Or am I wrong? Is it is it someone, is the accountant somewhere from the future and then came back to give future earnings, and so that the fundamental analyst can accurately predict the future? Is that how it works? I'm not sure. I'm not a fundamental analyst, but I don't think that's how it works. Okay? Uh, so, no. Um, this objection that technical analysis is no good because it uses historical data is just, I don't know how to call it, because every form of forecasting rely um, on past or historical data. Next, here we have the concern that fundamental analysis is the more serious approach. I'm not sure what that means, but you often hear this, and technical analysis is some kind of a not so serious approach. Well, I don't know where this came from, and I don't even know what this means. What this means by a more serious approach. I think what they mean is that most financial analysis um, are given by people with coats and ties and sort of those things, while technical analysis are given by people with shirts. Maybe that's it. I really don't know. And and why is that? Why is that? Well, let me tell you. Okay. Well, to be really honest, there is somewhat of a truth to this. Okay, because fundamental analysis, like I said, um, requires knowing the intrinsic value of something. Okay, and to know that, you have to use some tools which are quite academic, right? You need to know things like a balance sheet, right? So things like ratios, um, profitability ratios, debt ratios, all other kinds of things which are highly technical. And um, those who perform analysis like this are usually from brokers, um, funds, financial institutions, and they are usually like a doctor in economics, like that. So, or in finance, or accountants, like that. So, this gives the impression that FA is the more serious approach, because the people who do those things are more serious, or at least looks more serious, right? And on the other hand, technical analysis is since technical analysis is approachable, then almost anyone can look at a chart and say, "Oh, it's going up," and then they can draw lines, and then anyone, including their dogs, draw lines on charts, and then claim to um, perform technical analysis. So in a way, there's a truth to that, because of TA's accessibility, almost anyone can do it. Um, Although I have to qualify that while a lot of people can do it, can draw lines, but drawing the proper lines is a more um, difficult undertaking, and only the professionals, only those with real market experience, only those who studied technical analysis seriously could, well, we can all draw lines, but my line can be different from yours, right? So so that's how it is. Unlike in fundamental analysis, well, it's so hard to discuss about um, economic factors if you don't even know economy. If you don't even know the economy, or how economics work, or how the financial system works. So, money supply, things like those. It's part of fundamental analysis, and it's not. It's just not very accessible to everyone. So only those with suits do that, right? So it gives the impression that technical analysis is the more serious approach, but actually, that is rather sorry. That's fundamental analysis, the more serious approach. But actually, real and proper technical analysis um is actually serious. It's just that it involves lines, and lines can be drawn by anyone. So it gives the impression that um, you know anybody can do that. It's not serious. You don't need a degree. You don't need things like those. So I think that's what gave fundamental analysis the more serious approach. Um, another thing is that um, brokers or any institution or company who wants you to buy stocks or any security would have to convince you, right, that it's a good buy. Okay. Now, if they use technical analysis to convince you, it would be very hard. Why? Okay. If the security is rising, then there's no problem because they don't even need to actually sell it because people will be buying if something is going up, right? The problem comes when the security is going down and they want to sell it to you. Okay, so how do they do it? Will they do it using technical analysis? No. Why? Why not? Why not? They won't do it using technical analysis because it would be very clear to you that it's going down. So why would you buy it? Because technical analysis is visual, and you can visually see that that thing, whatever that stock is, it's going down. Why would I buy it? Right? So how can they convince you to buy it? Well, they use fundamental analysis. Why? Because you don't know anything about that. They're going to talk to you about, yeah, well, do you know that they just opened a plant right now. They are increasing production by 30%, and those increase in production would yield like this and like that, and then it's going to contribute a lot to the bottom line. You don't even know what the bottom line is, and you just nod your head and okay, I'm gonna buy that thing. Right? So the suits people prefer fundamental analysis to when they are trying to sell something to you, because if they use fundamental analysis, rather technical analysis, it would be clear if it's going down, and you're not likely to buy it, and it would be very hard to convince you to buy it because they're gonna say, "Oh yeah, it's going down, but it will come up so soon," because like that. But if they talk about, um, production will increase, we will be expanding into a new market, and that new market will embrace our product with open arms. They're going to be um, trampling on each other to buy our product, and then they're gonna shout, "Take my money," and something like that. And then you're gonna nod your head and wow, wow, I want to be a part of that. I want to buy that stock. I want that. Okay. And they're going to show you all these kinds of numbers that you don't even know what it's about. And then, in tables, and wow, all those big numbers. And then, but a chart, if they show you a chart, you can easily see that, why? What? It looks like it's going down. Right? But they do, if they talk about economics, and and you don't know anything about economics, and then they'll talk about money supply, inflation, how inflation would how the central bank is increasing, or rather decreasing the loan percentage, and that the company is going to borrow a lot of money for expansion this, expansion that, going to different markets, acquiring other companies, going to different countries like that, and then expansion this, expansion that, capex, increasing capex, and then acquiring, mergers, acquisition. I don't even know what those are. And then, oh, it must be a good thing, right? So it's easy to sell you something using fundamental analysis. Since that is the case, then the suits who want you to buy would use fundamental analysis, and then you begin to people will begin to correlate fundamental analysis with suits and technical analysis with shirts. So, oh, it must be the serious one. So I'm going to use fundamental analysis because that's what should be used, because that's what's being used by the serious market practitioners. But did you ever ask why? Why that is what they're using, right? So, yeah, that's it. So let's move on to the next. So now we are moving into the more to the best stuff. We're going to discuss. I'm going to tell you why I prefer technical analysis. So I already told you at the start of this video that I prefer TA. So I explained to you what FA is, what TA is, and what are some of the objections or complaints some people have in TA. Now, why do I prefer TA? Okay, here's the list. First is TA requires less guesswork. I did not say no guesswork because, as I already discussed, there will always be some amount of guesswork when you are forecasting. It's just that in technical analysis, that guesswork is reduced to a minimum, while in fundamental analysis, you make all kinds of assumptions, and then just one of those assumptions fails, then your forecast is off the mark. Depending on how important that assumption is, your forecast could be way off the mark. So that's why the amount of guesswork is important, because sometimes it would compound. Okay, like you made two assumptions. One assumption depended on another assumption. Imagine that. And then the latter assumption proved false. So the other assumption that depended on that would have, no leg to stand on, right? So it would fail spectacularly. So what if there's 3 levels of that going on? It's not a pretty sight, right? So if you can minimize guesswork, then all the better. In the case of technical analysis, the only guesswork there is that the trend would continue. And that is actually a reasonable assumption, because even in the physical world, in physics, there's a law regarding that. Newton's law, right? That an object at rest tends to remain at rest. An object in motion tends to remain in motion. It's the same thing. An uptrending stock tends to remain in an uptrend until an external force acts on it. Same with a downtrend, okay? And you say that, well, physics is different from finance. Yeah, but it is actually analogous, because physics deal with physical forces. Finance, the markets in particular, who are in the markets? Who does the buying and the selling? People. And how do they base their buying and selling? A lot of the times it is about fear and greed. That's the psychology of the market, fear and greed. And those things are emotions. And emotions are forces. It's just a different kind of force, but it's still a force. And and if you are afraid of a stock, then that fear would tend to there's a momentum to that fear. You just won't, okay, I'm fine now, and then it would slowly die down first before it would reverse. It's just like it's just actually like an actual physical object that is acted on by physical force, right? So emotion is I would say a type of force that would still um, analog- analogously be that is analogous to a physical force. So in which case, the laws on motion in physics could analogously be applied, by analogy. Okay, not one to one correspondence like that, but by analogy. And well, yes, it's not really that accurate, but it does um, work. It does work. Okay, so even that guesswork is not really guesswork because um, a trend in motion will tend to stay in that direction. Okay, unlike in fundamental analysis where there is a lot of things that's happening that you just don't know that could change in the blink of an eye. You have no control over those things. So that's one of the reasons why I prefer technical analysis. It requires less guesswork. The next is it is more reliable. Okay, what do I mean by more reliable? Um, by more reliable, what I mean is that there's two parts to it. First part is somehow related to the fact that there is less guesswork because if there is less guesswork, then it follows that it's more reliable, right? The more guesswork something needs, the more unreliable it could be. There's more potential for failure, right? Because there's a lot of moving parts, so to speak. So the lesser guesswork, more reliable. And then what is the other aspect? What is the other aspect of reliability? Why do I consider technical analysis more reliable? Okay, so here's the thing. Let's go back to what technical analysis is. It relies on price action. Technical analysis uses for its analysis the price of a security, of a stock. Okay, so what is that price? Well, let me tell you, that price is reliable. And since that price is reliable and TA depends on that price, TA is reliable. Why is price reliable, you ask? It's reliable because when a price is printed in the ticker or on the chart, it only means one thing and one thing only. It means that a transaction happened at that price. Okay? You can't put a price on a chart without anything happening. If it went up to 113, it's because someone bought it up to 113. That's why it was recorded. Okay? So everything that's printed on a chart or on a ticker tape actually happened. And then you say, yeah, okay, yeah, of course. But what about fundamental analysis? What's the difference? Well, in fundamental analysis, what's fundamental analysis again? It relies on figures that the company puts out. Okay. So, um, I'm not sure if you are aware of something called creative accounting. Okay. Those are legal ways of, I won't say manipulating, but putting something in a different light. Okay. So there is some leeway on how things are considered. Let's get a concrete example. Let's say in a balance sheet, and under assets you have goodwill. Okay, how do you value goodwill? Right? It's subjective, right? I mean, my goodwill, my company's goodwill is worth, let's see, $20,000, right? $200,000, a million. Okay, so okay, and how do I price other intangible assets, like for example the company logo or our patents, the patents that we own? Okay, so see, um, there could be a variation in how that is represented in the financial statement. Okay, and that's just the legal side of it. I'm sure you've heard of instances when um, the SEC or some government agency would go after companies for some misrepresentation. It doesn't happen so much in the US, but in some countries that could happen. Okay? So, what I'm trying to get at is that FA relies so much on financial statements, and sometimes the degree of reliability of those financial statements could be questionable. Not in all cases, not all the time, but it could be. And how would you know if this instance belongs to the other side, the reliable side? How do you know that, right? So there's that uncertainty, right? Especially when you um, venture into other stock markets that you are not familiar with, that you are not familiar as to their accounting procedures, as to things like those. But if you're a technical analyst, you can jump from market to market, and you can trade the stock markets of different because it relies on price. And like I said, price is reliable because if it's printed, it's bought or sold at that level. It can't be printed unless there's a transaction that happened there. Okay. Well, some would say that, well, I've heard of market manipulations in the stock market and it would reflect in the. Yes, of course, that happens. But even those things, they actually spent money to buy or sell stocks. Okay. In order for the print to happen, in order for them to so-called in order for them to so-called draw the chart. Okay, and and even in those instances, a sharp technical analyst can see those manipulations. There are actually ways of looking at that and finding those things in a chart. Maybe it's not foolproof, but but it's there. Unlike unlike in a, for example, a financial statement of a stock in a stock market you are not familiar of, right? It's very um, I would say that the reliability of relying on the price is way better. Okay, so the next is TA is more accessible. I already mentioned this regarding a while back when I said that it seems like FA is like more of a real thing because those with suits are doing things like that. Mostly those with suits are doing those kinds of things, while TA is used by those with shirts, right? Um, that's that's actually a good thing because imagine if we don't have TA and all you have is FA, and then you have to you can't even start doing analysis and joining the market unless you get a degree, right? So it's that's also the beauty of TA, because it's more accessible, and you don't need some of course you still need to study, right? You have to study TA, except that it's more intuitive, and you don't, because it's not that TA is easy, it's just that it's the nature of FA. It's the nature of FA that they need to determine the intrinsic value, like I already said. And to determine that intrinsic value, you need to know a lot of things. You need to know economics, you need to know finance, you need to know accounting, you need to know all, you need to know, daily operations. You have to understand foreign exchange, intermarket analysis. You have to, because most businesses right now, especially the bigger ones, are multinational. So you have to follow the news of every different countries that the company operates in, or countries where they have suppliers or distributors. So that's a lot, right? That makes it less accessible. It's not that you can get by in technical analysis without having to study. No, because you have to. You have to study. Except that it's just so much to to um to to grasp, to hold, to take for fundamental analysis. So it's not as accessible as TA, and well, that's part of the reason why it is used by the suits, right? And not by the shirts, right? So especially since that, for me, TA is more effective. So why do I have to go through all those hoops when TA is at least as effective, or even more effective than FA, because of reliability, which I just discussed, right? So it just, for me, it just doesn't make sense. Next is resistance from insider trading. Okay, so I mentioned this a while back in reliability, wherein there can be some manipulation, market manipulation. But if ever that would happen, well, you can still see that in the charts. There would be telltale signs on how the market moves. That's where patterns come in, because there are patterns for some sorts of things. And in a future video, I would discuss those things, which is why you should subscribe and like and click the notification bell. Right? Anyway, so if there is insider trading, it's very hard to determine using fundamental analysis. Why? Because fundamental analysis relies on financial sheets, financial statements by the company, and who does those financial statements is the insiders, right? So it's really hard. But in technical analysis, if there is insider trading, what will happen is this. So the insider will have insider information that, for instance, that an information that would bring the stock down. So what they will do is that they will sell before that would happen, right? That's the definition of insider trading, right? And I hope nobody's doing that, but if ever someone's going to do that, that's how they're going to do it. So if ever they're going to do that, a chartist would notice that in the chart, that there is some weird selling going on, and they'd be prepared, right? So that's one of the other benefit of technical analysis, because market movements that are weird, that doesn't fit the pattern, could doesn't automatically mean that there's something fishy going on, but it could alert you. It could, keep you on your toes. So, oh, okay, so I better be careful, or I better set my stops. I'd better, things like that. I'd better be vigilant, because something seems to be happening that I cannot explain. Something weird's going on, right? If something smells fishy, then then there there could be something wrong. I'm not saying that there's always something wrong, and well, I'm not saying that people are always doing insider trading, not anything. But but if you watch the news, you would see things like those happening. And if ever they'd happen, then you'd be aware because, like I said, any buy or sell, any buy or sell would reflect in the chart. And anomalous buying or selling, that means anomalous buying and selling would also reflect in the chart. So if it would reflect on the chart and you know TA and you know how to read patterns, then you'd be aware, you'd be warned, right? And you can't do that in FA because you don't use a chart, right? So technical analysts are more aware of this, are more have the potential of being warned earlier of anomalous transactions like that, right? There's a sudden rise in price, sudden decline in price, things like that, and so they would be warned. So that's it. And next thing is technical analysis can be used alone. By alone, I mean without the need of fundamental analysis. And then you say, why? Would fundamental analysis require technical analysis? Well, sometimes yes, because fundamental analysis would only tell you that, again, the intrinsic value of something, right? So after doing FA, you realize, after doing FA and getting the intrinsic value of a stock, you realize that, okay, it's a buy. Okay. But when do you buy? Right? Now? You know that the stock is cheap. Should you buy now or a bit later because it might become cheaper? Right? It might become cheaper. So now, so that is a question of timing. And that is better answered by technical analysis. So sometimes even fundamental analysts would have to learn to read the chart, right? But technical analysis, no, they don't need a chart. If they see the price rising, then it is rising. They would just assume that there must be some fundamental reason for the rise in price. Maybe something good happened in the company, maybe earnings improved. I don't know and I don't care. As long as it's rising, that's a good thing, right? Do you really need to know why? Okay, so that's the mindset of TA Fox. They know that there's a reason why the stock price rose. They just don't care what that reason is. But they do admit that there's a reason behind that, and the reason is most likely fundamental. But it just doesn't concern them, right? So TA can be done without having to look for the reason why the price rose, to look for the reason why the price is trending up or trending down. The point is, it is trending down or it is trending up, right? It could be because of a new product launch, or maybe a new deal with a different company, or an upcoming favorable merger or acquisition, maybe something that isn't even released to the public yet, but there is a reason, and we don't care what that reason is, as long as the price is performing well, right? So that's the other thing. Now let's move on to the next topic. I wonder what that is. Okay, so it's still the same thing. It's just that it's so long because there's just a lot of reasons why I prefer TA over FA. So what's next is still the same. Reasons why I prefer TA over FA, part 2. Okay. So so the first on the list here is that it has broader applicability. Okay. This one is important. Why? First, what does broader applicability means? It means that if I am a technical analyst, I could use my skills to analyze stocks, and then futures, and then Forex, and then options. I could do that using technical analysis. Okay. And I can go to commodities. I can go to even if I stayed in stock markets, I could go to say the Singaporean stock market, the Hong Kong stock market, the European stock markets, in Germany, in London, in India. I can go to any um, stock markets, or even outside stock markets, into Forex, into commodities, into options, futures, into CFDs, into all kinds of things. Technical analysis has broad applicability. Why is that? Because all those things have prices. And technical analysis mainly relies on prices, right? Okay, compare that to fundamental analysis. Fundamental analysis is very specialized. If I do fundamental analysis on um, stocks, it's not easy for me to do fundamental analysis on, say, commodities in oil, because the fundamentals involved in oil is different. Oil has no earnings, it has no things like those, right? Like if you analyze a company using fundamental analysis, you use earnings forecast, revenue forecast, price earnings ratio. There's no such thing in the commodities market. Oil doesn't have that. It has different things. If you go to other commodities like coffee beans, you're going to be concerned with other things like weather, like storms that could affect crops, things like those. And even within the commodities market, if you go from coffee beans to oil or to pork belly, it would be different because um, um, storms doesn't really affect oil that much, or pork bellies, while it does affect um, crops, grains, right? Coffee beans, rice, things like those. So even within the commodities market, transferring from one commodity to another using fundamental analysis is a very difficult proposition. Imagine going from commodities to stocks and to Forex. Those require different fundamental analysis. They depend on different fundamental parameters, right? So you don't study storms in Forex, right? Unlike like you do in coffee beans, for example. So if you do fundamental analysis on coffee beans, you have to know weather patterns. You know, you have to study the seasons, harvest time, things like droughts. It would matter to a trader of coffee beans, but it won't matter much to a trader of currencies in Forex, right? They would require different parameters. So you cannot easily transfer from one um, security or commodity to another. It's not so easy. Even within the stock market, let's say, um, well, all stocks in the stock market would be analyzed almost the same. But say for instance, I specialize in tech stocks. Okay, so while they have price earnings ratio, just like the energy sector, like energy stocks, they have the same financial statements, right? They have the same ratio, but there are things in tech that I need to know, like the competitors. The competitors act differently because um, the climate, the surrounding circumstances in the tech sector is quite different from any other business, right? Like in the health sector, in the tourism industry. So, so even within the stock market, it's not easy to move from one sector, from one industry to another using fundamental analysis. But for technical analysts, that's not a problem, right? It's the same chart, it's the same price, it's the same volume, right? Regardless of you're trading tech stocks, um, energy stocks, industrials, mining, it doesn't matter. Or even if you go out of the stock market, or even if you go to a different stock market, an Asian stock market, European stock market, or you go to Forex, it would be the same chart, same price patterns, right? So that is very important. So you'd say, yeah, that's good, but I don't need to jump from one type of security to another. I just stay in, say, in the entertainment stock sector. Okay, then I'll do fundamental analysis in that. So I will be an expert in the entertainment industry, right? But there's a problem with that. You see, um, there's such a thing called a business cycle. Um, Business cycle is, there are times when the entertainment industry is booming, but sometimes it's not trending, right? And what will you do during those times when it is not trending? It's so hard to trade in a non-trending market, right? For example, tourism. Okay, that is so seasonal, right? So during some seasons, businesses in that sector would trend higher, would boom, right? But in non-peak seasons, it's not so um, attractive. So what will you do? You'll sit by the sidelines, right? Because there's no trend. While for the TA, the technical analyst, well, okay, I'm I'm trading tech stocks right now. Wow, it's in a let's say it's 1999, and the tech boom, the dot com boom. Wow, I'm going to ride the rocket to the moon, right? And then instead of going to the moon, it fell back to Earth. So I get out. And then okay, I'll move to commodities. I'll move to Forex. I'll move to something else that's trending, right? I have that flexibility because I can transfer my skill to those markets. Whereas in fundamental analysis, it's not as transferable. The application is narrow, it's not as broad, right? So that's the problem with that. You can say that, oh, okay, it's okay if FA is not so broad, if it's just narrow. I'll just stick to that narrow sector of mine and become an expert in that. That's good, but sometimes you just have to move because that sector is in its low or not trending or is off season, something like that, right? And it does have some seasons like that. That's why there's such a thing called business cycles, right? Okay, so that's the importance of being able to jump from one market to another, having that flexibility. That's a very important thing. Flexibility is very important because of that reason. You will not be tied in a non-performing market because sometimes there are seasons and periods when a market is not performing and you don't want to be in that market. You want to move to a different market. It's so frustrating to stay in a market that is not moving when you see other markets that is moving. It's just that you can't go there because you don't have the skills to navigate that market. But technical analysts, they can jump from one market to another, no problem. So that's it. The other thing is more precise entries and exits. That's another benefit of DA. What do I mean by that? Um, Um, Entries in TA is granular. Um, in fundamental analysis, like we discussed, they are mainly interested in determining the intrinsic value of something. After they determine that, then they would decide, okay, so the intrinsic value of this company is 50. Okay, it is currently trading at 10. Very low, right? It's supposed to be 50, but it's just trading at 10. I'm going to buy that, right? Okay. But again, like I said, when do you buy it? Because tomorrow it might go 5. Right? So so it's not so precise when you just rely on FA. You will know that it's nice to enter, but you have mm, um, no idea. You don't have a you don't have good information as to when to enter, right? Okay, I should enter, but I'm not sure when. So, um, why is why is precision important? You'd say that, well, I don't need to be precise as long as I enter while the market is cheap, right? Well, partly. That could be true in the stock market. Your entry point doesn't matter as much as long as you enter low, right? Buy low, sell high. It doesn't matter if it will go lower as long as it will go up later, then no problem. You just hold your securities, just hold onto your portfolio and then wait for it to go up, right? No problem. But that's just in the stock market. That strategy won't apply in the Forex, in CFDs, in in the futures market. That won't apply. Why? Well, in those markets, precision is important. Why? Because those markets are highly leveraged. What do I mean by that? Um, the leverage is so high such that if the market moves away from you even slightly, your loss is great. And when your loss is great, you will receive a margin call. And then your position will be closed off. Even if you turned out correct that it would go up, but if it goes down in the meantime because you went in too early, then you will be wiped out because of the high leverage in Forex, in futures, commodities, CFDs, and other derivatives, in options. Those are highly leveraged instruments. So that's the danger. So it doesn't matter if you are. Let's have a specific example. Let's say price right now is 100, and I know it is going to go up, so I buy at 100. Okay. So now I bought at 100. It just so happened that indeed I was right. It's going to go up, but it just so happened that before it went up, it went down first. It went down, and because the instrument is highly leveraged, any move away from me would take a huge loss from my portfolio. And then, if it moves far enough, my position could be closed by the broker. And then I will close at a loss, even if an hour later it does indeed go up. But that's water under the bridge because I'm already closed. I was already at a loss. My position was already closed by the broker because it went down, right? That's why timing is important. Technical analysts would see that yes, it's going to go up, but it's going to go down first. So I have to wait for that to go down before I enter. That's the difference between precision and um, non-precision entry. It's so painful, right? It's so painful to lose, uh, to have a loss because you are wrong. That's painful, right? But you know what is more painful? What is more painful is that you had a loss even when it turned out you're right. That's so painful. Okay, you're right. You're right. It would go up. It indeed went up. It's just that you came in too early, and before it went up, it went down first, and you got you got a margin call. Your position was closed at a loss, and then it went up. That's painful, right? That's why when you enter matters, it's not enough that you know that it will go up. Okay? It's not enough. Even if you know that it will go up and you are right, if you don't enter at the right time, it's still possible for you to end up in a loss. In stocks, that's not much of a problem because you can just hold it for so long and then wait for 10 years until it comes back up. So it's not a problem. But that's just in stocks. That's also another another point for the broad applicability of TA because because of precision entry. Because it has precision entry, it can be applied to highly leveraged markets like futures, commodities, options, CFDs, Forex, things like those. If you are not interested in precision timing, I suggest you stick with stocks. Okay, so lastly, the final thing, and for me, actually, it's the most important. It says here, you can take advantage of expert knowledge if you use TA. Why is that? Why is that? What do I mean by that? This is very important because, okay, again, this goes back to our discussion on what fundamental analysis fundamentally is, and what technical analysis basically is. Okay, so again, fundamental analysis is about determining intrinsic value. We go we go back to that over and over and over again because it's so very relevant. The problem with determining intrinsic value is that you have to know a lot of things to determine intrinsic value. You have to know economics. You have to know intermarket analysis. You have to know how foreign currencies interact, how countries interact, how what their central bank policies are. Are they dovish right now? Are they hawkish? What are their economic stability? What is their political climate? You have to know all those kinds of things if you want to know the intrinsic value of something, and that's the goal of FA, right? So it's very hard. So what? So because of that, we mentioned a while back that because of that, it's not so very accessible to regular peoples, to one man bands, right? so so regard even if you are an expert in finance, you can't know everything, including in economics, all the theories in economics, in accounting, in investigative accounting, in things like those. So you can't be everything. But big funds, insurance companies, big banks, big hedge funds, big oh, financial institutions in general, they have a whole department of research analysts doing things like that, right? They study things like that. And little people like us can take advantage of that. How? How, you say? How, you ask? Okay, so we don't have their muscles, so to speak. We don't have their power. They have all the funds to hire physicists, economists, um, expert financial analysts, masters in finance, PhDs, and all those kinds of qualifications. They have that in their in a room somewhere. they have they have a department for that, right? So those things are doing nothing but studying the markets. They have experts just in oil. They have experts just in coffee beans, just in US dollars, just in, those things. Okay, so when those experts determine the best action to pursue, okay, so they study, right? They study so hard. They have smart people over there that study these things so hard. And what's the effect? What's the result of that study? They would come up with a decision like, okay, based on all our experts, based on the hundreds of experts that we employ, the best course of action is to buy Tesla. Let's say like that. Okay? So what do they do? Of course, they won't spend all those research and then do nothing, right? So they do all this research and buy Tesla, right? And the other funds, the other insurance companies who also have hundreds of talents would also do the same. They'd buy Tesla, right? Okay, so how does that help us? Well, if they buy Tesla, what did I say? If they buy anything, it will get printed on the chart. So we, technical analysts who watch the charts, would see massive buy orders from different people buying Tesla. Okay, so I don't know why, because I don't have 100 experts in my backyard or in my in one of my rooms. I don't have 100 highly specialized experts there. I don't know why, but I do know that the big guns are buying Tesla. So what does that mean? It means there must be something good with Tesla that they found out with their hundreds of experts. So what do? I buy Tesla. Okay, so I got the advantage of expert research and without employing hundreds of economists and banking and finance doctors, physicists, and all computational statisticians and those experts. I don't have them, but it really doesn't matter because whatever they come up with, it would be either a buy or a sell. And either way, if they buy or they sell, it would get printed on the chart. And if I know how to read my charts, then I'm going to see those signals. And if I see those signals, I'm going to act on those signals, even if I don't know why. And again, technical analysts like me don't care why, because we already admit that we cannot know everything. Even those big hedge funds, even those big financial institutions, that's why they employ hundreds, because not one can know everything. So they have to have plenty, right? And fortunately, you can take advantage of that. So that is a very important. I think that's the most important part of why I really, really like technical analysis, because it's impossible for the big boys to move without leaving an imprint on the chart. The bigger they are, the bigger their move. It's like a whale, right? It's like a fish. A small fish doesn't move the water very much, but if a whale moves, if a huge fund moves, it is going to make waves in the sea and in the markets. and I am watching for those waves. So that's it. So that's the last and most important reason why I prefer technical analysis. Great, so you've reached the end. Yay! That's awesome. Now, you are ready to learn more about technical analysis and the markets in general. Awesome job, guys. But to learn more about this, then you have to watch my other videos, because I will be uploading more videos about this trader education, trading strategies, more on technical analysis, and even some fundamental analysis for you guys out there who prefer that approach. And for you to be notified of those later videos, it would be great if you could subscribe and hit the notification bell. And it would also help this channel to help you in your trading. And if you like this video, please hit like, because, well, you like it, right? And I'm sure you like it, right? I do hope so. So that's it. Have a great day, guys, and enjoy the markets. Play safe, and don't get swept out by the whales. Okay. So that's it. See you in the next video.